So this is a question comes up a lot, so I thought I should put it in a video, which is time frames in SQX. What time frames do you download in TradeStation and to bring in? So say you don't have the data subscription in SQX, or even if you have it like me, I don't, the data in TradeStation is cleaner and you want to bring it in. Theoretically, you should go here, bring your data in as 1 minute, and then from the 1 minute, of course, you can build any time frame. So for example, this is 24 hours based on 1 minute, so I can go 1 minute, 30 minutes, 1 hour, anything. You can even actually do custom, which is really nice. So that's if you want to use the whole data, then that works fine. The problem comes in when you want to limit the data. So perfect example is ES, and if you want to trade the ES only in the day session, that's the most active time. You don't want to trade after hours or pre-market, and you want to limit that. Of course, we have a tool here which is called sessions, and for example, let me show you. This is the let's pick the ES again, and right now let's go to half an hour. So you can see it's behaving correctly. The data starts at 5 a.m., continues all the way to 23 and a half, and then start at 00:30. So it's all good. And if I put a session, say 9:30 to 3 Eastern Standard Time, it behaves also correctly. This is 9:30, 10, all the way to 15, starts again at 9:30. And even if you want to see the chart, you can see there are these gaps because that's the time at 15 and this is the time at 9:30. So it behaves very well. The session knows exactly what's happening, which is what you wanted to do. The problem is this: that session I just showed you in Data Manager, it has no effect on the trading logic. So here, this is the data and there's no session. And I'm gonna run full back test. This is just it's not a system per se, I'm just testing the theory behind it. So it's a short SMA, 10 above the previous SMA, we go long. When it's below, we go short. And we have, look at this, we have 747 trades making 37,000. Now, if I go to limit the time, 9:30 to 15, remember we have 747 trades, 37,850. Nothing happened. But of course, that shouldn't be the case. And I made an example here. So this is ES.D, meaning only the day session, 9:30 to 15, what is it? 9:30, 15:15. That's the day session, okay? And this is the normal, also this is 1 hour. So these are 1 hour bar on the left with day session. These are 1 hour bars on the right with 24-hour session. Both of these are 10-day moving average. So this is the blue line. You can see it's 10-day of close. And the yellow, it's 10-day of close. And let's take this example. So this moving average was going up, it turned down here. And that is at 12 p.m. on October 26, it turned down. 12 p.m. October 26. And if I go here, look at this, my moving average, my moving average is going up and it turned down here. So that's October 27 at 11:30. And of course, this makes sense because the calculation of the moving average now changed because some bars are missing. It's impossible that the moving average here is the same as here, because here we have more data. Obviously, it's going to affect the moving average. But in StrategyQuant X, that didn't happen. It didn't affect it at all. Zero. So then in that case, if you want to trade the ES in the day session, then you have to import the day session. Or let's say I've showed you my activity. Let's say for natural gas, maybe you only want to trade between 9 and 12. Now I know you can limit the session here. So you can go and say, so we can go to 9:30 and 15:15, or even let's make it the same as this one. So this session, I just limit it right now. The problem, this is only gonna limit the logic to take a signal or not. It's not gonna limit the calculation. So what I'm trying to say is right now, we can see that some trades are happening at, for example, this 7 a.m. and this is 1 a.m. and this is 8 p.m. Now, when I limit the trading here, those trades will be gone. So you can see now all my trades are between 9:30 and 15:15. But that did not affect the calculation again. It's only affected, it's like a Boolean variable. If it's after 9:30, allow the trade to happen. And in fact, you can see it in the code. See similar time range from 9:30 to 15, signal time range from 9:30 to 15. This variable now will be used as a filter to get the signal on or off. So if this filter is on, we will trade. If it's off, we will not trade. But it did not affect the calculation of the SMA at all. So from all this, you need to keep in mind that anytime you want to trade a subset, because this shouldn't be the day session only. Say, even for the ES, I want to trade only the morning session. And I want to base my calculation on that session. Because remember, it's going to affect gaps. It's going to affect calculations of all indicators, RSI, MACD, moving average, anything, noise, like Kaufman efficiency ratio. They'll all be affected when you change the session. So whenever you want to do that, then you need to import that time separately. So for example, here I have, look at this. So this is a daily session from 8:30 to 15. So in TradeStation, I build a daily session. It doesn't matter if it's intraday or daily bar. I just limit the amount of data from 8:30 to in this case 15, and then I bring it into SQX. So SQX, when I open this stream, SQX cannot cheat because it doesn't have the data anyway to cheat. So when I ask it to calculate moving average, RSI, whatever it is, it will be based on only the data available. And this is a long-standing bug for sessions. And anyway, yeah, it's there. You need to be aware of it.
I mean, the advantage of having session is because you wanna to get rid of the noise of the overnight session.
Well, you can use sessions, in any way or shape. Like I just told you, let's say you want to build a gap strategy on Euro USD. So Euro USD only close on, I think, 6 Friday Eastern Standard Time and open 6 Sunday. I think. I'm not sure. This is at least in futures. But say you have 24-hour market and well, there is no gap. It's trading 24 hours. Let's take Bitcoin today. Well, Bitcoin trades globally 24 hours a day, all year round. There is no stoppage, zero stoppage. But definitely Bitcoin trading has different activity during New York time because there are 2 contracts in Chicago, and that will increase activity. And so you can theoretically build a session that has gaps in Bitcoin, and then you can build a gap strategy. So it's not necessarily only to filter noise. Like, I want to filter most active periods. Even the ES, most active liquid, you can easily build a session from 9:30 to 12:30 a.m. PM Eastern Standard Time. That's the most active time. And in fact, most strategies will do much better if you skip 12:30 to 2:30 in ES, because most of the signals are fake signals during lunch hour in New York. And so sessions is really good, really useful. And in fact, this is, again, it will be in the course, but I'm going to give you right now. Another way to diversify strategies is to change the session. So say you're building a breakout intraday. That breakout takes some starting hour, say 9:30 to 10:30. And then after that, it looks for a level to go long or go short. If you change that session, say from 10, so it's going to start at 10, that level is going to be now from 10 to 11, that will produce different signal than if we start at 9:30 and your breakout start at 11. Because you omitted some data, which could be good and could be bad, but it's definitely going to produce different signal. So session is also useful in diversifying the signal strategies, even though if they are the same logic. Say these are half an hour bars. Okay, so this is 9:30, 10, that's 11, 11:30. And say we have another one. If I build a breakout strategy from 9:30 to 11, okay, this will be my low, and this will be my high. And then after 11, I looking for a breakout. Same logic. If I'm looking at the high and the low, but now my session starts at 10. So now this is my low, and this is my high. So the low here changed because I had a different session. So same logic, same everything, but now the signal level has changed. And so that will affect, of course, the signal generation, even on the same logic, let alone if you use different logic. So session is really important. I think it's one of the good tools to use to diversify strategies. And you can use it, you just cannot use it in SQX the way it's implemented. You need to import data that it is especially for that session.
Right, but in the case of I don't want to filter sessions and I want to have all the data, it's enough if I download the M1 data. Is it the same as the daily data?
So if you download M1, so this is TradeStation. Don't think of the resolution. Think of the session. So ES, it's a 24-hour session. Okay? and es.d is the daily session. This is just instead of going to sessions and pick, because of course you can do this. You can go edit session, and you go properties, and then you can pick your sessions. But when you put .d, it automatically limits it to the day session. So if you export .d, es.d, even at M1, it will not have anything after 15:15. If you export ES, which has 24 hours, you didn't apply any session, then M1 will go, of course, from 12 midnight to 12 midnight again the next day. Then if you used daily, like if you go SQX and say the logic now, say this, so you use close D, okay, daily close. This daily close on this data is 12 midnight, because now your bar starting 12 a.m. ending at 12 midnight. And this is really important in futures, which is this is futures. In that case, the close will be, of course, depending on the future contract. Now we're getting into deep, but for example, the future contract here I think closes at 5. Let me see, what's the break? 18. So your daily close here will be 18, because, and some futures, actually, let's look at currencies, Forex. So Forex, your close will be next day, because that's how it's calculated. It's starting, I don't know, some, let's try Euro USD. Again, 18. So Euro USD, it's also the close is at 18. So if you import that data in and you use the daily close, then that daily close is not 15:15 anymore. That close is 18. And that's why even in if you have subscription to SQX data, you always, for futures, you always have the simple .d, because .d stops it at 15:15 for most futures. Some futures stops at 2 p.m. This is only a problem in, not a problem, I mean, this is only you need to take care of in futures. Stocks, it doesn't matter, all of them stops at 16. They have pre-market, post-market, but it's really easy. In currencies, I assume if you trade currencies, you already know this. You already know that the day is 24 hours. So if you want to use the daily close in SQX and you want to fix it at, let's say at 15, then your data has to end at 15 in order for that daily close to work.
Let me rephrase the question. If I got all the M1 data, and I went later on, I want to trade like daily bars. The data on daily from TradeStation, it would be the same as if I download the data from M1 and on SQX I put the daily, or I just have to download again the daily data.
They should be the same, but of course they are not. So this is ES. So this is ES data, 1 hour, January 1st, 2019 to April 6th. So 1 hour, January 1/19 to April 26. Here we have 468 trades, 41,950. Here we have 456 trades. So it's very hard to match the data exactly, but in theory they should be the same, but they will never be the same. No two data providers will have the same data. I tell you why the big difference here. The ES is back adjusted futures contract. This one stops in April. That's the last data I have. Today we are in October, that's 6 months. So all these prices have been adjusted already. If I download TradeStation data again, even TradeStation with TradeStation will not match, because the back adjusted futures, play with the levels up and down. But I understand your question. M1 24 hours on SQX is the same M1 24 hours on TradeStation. Theoretically, yes, let's say 95% of the time. But the data in SQX is dirty and it's cleaner in TradeStation. So there will be some gaps, but it shouldn't be too big. It shouldn't be here 200 trades and then using the other data to 400 trades. It will not be that big.
Let's say I want to develop some H1 strategies. Should I download the H1 time frame instead of the M1 time frame?
No. As long as you're using the full data set, that will not have an effect. So you always download M1 and then you build your bar. It will only has an effect when you limit, like we discussed, the session. So if the session is 24 hours, then only download M1 and build your bar.
So it's equivalent.
Yes, in SQX and in TradeStation is the same. Yes, but just like I said, it's not gonna match 100%. Okay, the next big subject was by Mike, and then some comments on it, and it basically talks about the holdout period. So we need to understand the concept. Okay, so say you have a strategy. Say you're doing your testing building strategies in 2010, and you left last 2 years, which is 2008, let's say, to 2010 as the holdout period. And your strategy is trading all market regimes. There is no filter for market regime, and it's producing, let's say, in bull market, let's say your average trade is 450, and in bear market, let's say your average trade is 10. It's profitable, the strategy is profitable, you have lots of trades, but it's edge in bull market. So now you will test on the out of sample. You're not seeing the chart, you're working in SQX. It's gonna test this on this holdout period, and it will look horrible, because this is the 200-day moving average. I'm saying the strategy doesn't filter, it just doesn't produce good average trade in bear markets. And then if you look at here, October 2007 till October 2010, you are mostly in bear market. So this strategy, if you're comparing in sample and out of sample, or if you're comparing the previous performance with the holdout period, will fail. Correct? Because my bear average trade is $10, and basically my holdout period is all bear market, and I will get an average trade of $10 theoretically. So even though the strategy is good, and I know because I tested it and I know it produced poor results in bear markets, but it does well overall, and we don't spend a lot of time in bear markets, so I'm gonna use it. But then because I'm not looking at the chart, I don't know that this period was bear market, and therefore I will disqualify this strategy. You will find this is the net profit per year, and I just put an example here that if our holdout period was this is what you will get as an out of sample. And you might say, well, my strategy is underperforming. This is how it looks like, which in reality your strategy is just behaving as it should be, but this is how it's going to look like if you look at yearly returns. So the lesson is what? The lesson is you need to understand, even if you're not using market regime as a filter, even if your strategy is trading all the time, you need to understand the behavior in each market regime. So for example, here I divided my strategy bull and bear, and here I know I am in bear, so I should expect my strategy to give me on average $10 per trade in this market. Or let's say you have a filter that you only trade bull market. Let's say same strategy, you tested it, and now the strategy is not doing well in bear market, so I put a filter: don't trade when the strategy is below the 200-day SMA. And I tested on the holdout, and again the performance will be poor. If I'm looking at the yearly performance, it will be poor because first of all, I have only this blip and this blip here and maybe 3 months here, and then the rest of the time I'm not trading. So when I look at the yearly performance, it will look bad in 2007, 2008, 2009, 2010. All these 4 years will have a bad performance because I'm actually not trading a lot. And again, if you're not looking at the chart or you're not looking deeply, you will not get it. You will just say, oh, my strategy is not performing well in holdout period. So by design, you should have well thought out holdout period. Of course, the more data you have, the easier it gets, because you can easily split 5 years for holdout periods that you're hoping to have all kind of situations. And I mentioned this many times, we are lucky now because we have really good data since 2008. There is no huge structural market change since 2008. And we have good crisis, which is 2008 and the COVID. So we actually have really good data sets now. And I always leave 2018 and up because usually it is good. Like some markets it's not, but most of the markets 2018 till now, it's a good holdout period because it has a shock, a price shock, which is the COVID, and it has bull and bear market depending on which market you're looking at. Some markets you don't, like for example the ES doesn't have a bull market in 2018 till now. But you need to keep that in mind. Now, also the questions went on to say, well, okay, should I test other markets on the holdout periods to find out robustness, because I'm testing and I'm not getting good results? So my first answer was that you're not getting good results, not necessarily because the strategy is degrading. It could be, I'm not saying it's not. But also there might be a chance that it's bad performance because the strategy is not meant to trade whatever your holdout period is, or it is by design not going to perform well in that period. So you need to look at that part first. Say you solve that part, now you are sure, but now you're looking for robustness. I am in the camp that every strategy works on each market separately. So let me give you an example. I have a chunk of money with two more people trading trend following. The reason is trend following needs lots of markets, and so hence you need lots of money. So theoretically $1 million is, is a good starting point for trend following. Now trend following, let's say if we pick something between let's say if we go from 80 days to 150 days trend following system like this one. When the moving average is greater than the previous value of the same moving average, we go long and we exit, or we go short on the opposite side. This number I just gave you now will work on many markets. Now regardless of what you say, regardless of what I say, trend following is robust. It works. Hundreds of billions of dollars trading this methodology, this strategy in different flavors, and we know it works. If you apply this in funds, and in our fund, like I mentioned just now, we don't use one of them. We use different speeds. So for example, we use the 80 and we use 140, two different speeds. And for some market, we use 40 also. Why we use different speeds? Because one speed will not work all the time. So you need to match different speeds to get a better performance. Now also you'll notice, and we have 80 markets in our fund. Most of the time, of course, not all markets will produce good results, but some markets never produce results for the past 15 years. So these 3, 1, 2, 3 systems, if you combine them in a portfolio, and if you give it 40 years of data, will produce good results on, if you're trading 50 markets, let's say. Some markets in 40 years are horrible. What does that say? That says that yes, this is a robust strategy. It should work on many markets, but some markets also will not perform. That's it. It's just that market, whatever the fundamentals, whatever the manipulation, whatever you want to call it, it's just that market is not built for this strategy. Of course, the mantra in trend following is you cannot skip those markets, but of course we do, and we don't skip it. We don't take it out just because it doesn't perform. We have other criteria when to include markets. And I can tell you that a lot of hedge funds, they don't even use that criteria. They just trade that market, even though it produces losses. Mostly those hedge funds, because they have a lot of capital and they need to deploy it, which we don't have that problem. So coming from that point of view, even the best of the best strategies long term that works on many markets still fails some market. So I am in the school of shorter time frame, which all of you are, and I am one of you. I mean, I have strategies that trade long term, but actively trading, it's only short term. Otherwise, what's the point? If you're actively trading long term, there's no point in that, I can tell you. You can easily get 15 to 25% return using long-term signals. So the only reason you're trading short term is you want to get more return. So short term, then I would not worry at all about my strategy working on other markets. And also, if I plot, let's say this is the noise, if your signal is capturing something here, let me change, then you are above the noise. Then theoretically, the signal at this level should work on a correlated market. And when I say should work, it doesn't have to match. So let's say you build the RSI2 strategy, it's work on ES. On ES it produces $100 per trade. You put it on the Dow, which is also a reversion strategy instrument, and then it produces $70. That's totally okay. It should not perform the same, but theoretically it should. Now, when you take your signal down, now you're capturing some of the noise, then that is it. Then that strategy should not perform at all on a correlated market. It could, the probability I would say, I don't know, 5%, but it shouldn't, because obviously the noise in each market is totally different. The average true range is totally different. Tesla true range is leaps and bounds different than, let's say, Citibank. Both of them are stocks, both of them in the S&P 500, but they will not behave the same if you're going near the noise. So if you are, I mean, I cannot force it on you, but I hope you understand the concept that short time frame strategies should work on that time frame on that instrument, and it should not be the same on another instrument. Of course, by design, when you are doing robustness testing, you're already testing close parameters. So even though, let's say here you are close to the noise, and let's say, I don't know, you're testing 1 ATR. So when you go to robustness testing and you, let's say, doing SPP, well, SPP will change this to 1.2, 1.5, 1.6, and then you're testing if it's gonna do well or not. But you are testing on the same instrument. Once you bring another instrument, then I think you're totally, I think this is a mistake. Now, not everybody agrees with me on this, but that's how I make money on this, and I tell you it works. It's just people are mixed up because of this, because of the trend following. Because long-term trend following works on all markets, not all, most markets. And people coming from this area, or like people like, let's say, Perry Kaufman, Robert Pardo, or actually Robert Pardo is not even in that camp, but let's say Robert Carver, he is also really excellent guy in algo trading, and he comes from that camp. Because they all come from long-term systems, and theoretically long-term systems should behave the same on correlated market because it is above the noise. But if you're trading short-term, then you are in the noise, and you should not expect the same behavior in every market. Crypto, I found many times that the code exported SQX is not executing the rules. I'm not a programmer and I like the idea of executing code. I'm concerned about this code. It's not perfect solution. You have to remember this. I mean, probably SQX on their website, I haven't seen the new one. Probably they say it's just as easy, just export and import, but it's not that simple. It's not that simple, but it's not all the time. So let's say you exported 100 strategies. I would expect maybe, I don't know, 3 or 4 fail completely and the rest behave the same. At least that's my experience. The problem comes from the different settings that has to be matched manually. So I'll give you an example. Like the sessions we just did right now. This is a manual thing. You cannot do it through the code. If you're trading on ESD or on ES but a different session, the code will not pick that up. So manually you need to do this. So some settings has to match SQX exactly, but has to be done manually to make sure it is correct. And so most likely that's the culprit. Otherwise, I would say less than 4% will fail because of the code. Now, of course, each platform will have its own nuances. So it's much better to stick with one platform if you're planning to do this, because you need to be good at that platform. If you're planning to do this in TradeStation, then you need to stick with TradeStation, because each platform has its own nuances. You cannot just hop from TradeStation, MultiCharts, or MT4 and MT5. I don't know. Like you have to stick with one. The only good news we have, the only good news we have is SQX working really hard to implement their online execution. So at least in stocks, that will be solved very soon. And maybe within next year, we will have stocks, futures, and currencies all working. And that is a huge obstacle will be lifted, because then you only need to deal with SQX. So, which is good and bad, because the bad part then is if you cannot export the code, you cannot visualize it on the charts, because charting on SQX is horrible. So, it's always give and take. There is no perfect solution for all these things until you spend a lot of money. Okay, so we did this one. And then Mozy, for example, I have 10 strategy with fixed lot or fixed percentage. $1,000 need to for per strategy, and with used Monte Carlo on portfolio it shows 4,300. Means I can start portfolio with 4,300. So Monte Carlo will not work on the portfolio in SQX. So you need to bring all 10 strategies. Well, first, if you're working on single strategy, then yes, you take a single strategy, you run Monte Carlo on it, and you see at what percentage Monte Carlo shows negative return, and then you need to be above that level. So you keep increasing your starting amount until you are above that level. On 10 strategies, you need to put all of them in a portfolio and then do the Monte Carlo. So that's how you do it. And also, that's for fixed position. If you're planning to do position sizing, then another Monte Carlo on the position sizing. And then in interview with Clonex you said, I don't use exit indicator. I didn't get it. I don't remember exit indicator. Maybe you can elaborate. But exit indicator meaning, let's say RSI. So exit when RSI greater than 75. That's exit indicator. So I definitely use it. But maybe stop loss. So I don't use stop loss as an exit. I use it as a catastrophic stop loss most of the times.
One thing I remember from that interview is he said that he was using ATR, take profit, and stop loss, something like that.
Yeah, so you need to understand how these things works. It's not like it's not one size fits all answer. Let's go back here. Let's say this is the strategy. Let's say you're trading intraday. Like we mentioned, intraday has a lot of noise. If I'm trading intraday, any trend, this one, I expect it to reverse. I am intraday, a lot of noise. I don't expect a trend to keep going up forever. It will never happen. So it makes a lot of sense to use a profit target and a stop loss on this time frame. Okay? If I am trading the next level here and trend following. So let's say I'm doing trend following on daily time frame. Well, profit target doesn't work because the profile of trend following is this. Okay, and let's say this is 0. These are losses and these are profits. Trend following works only because of this part, okay, which is less than 5%. So any trend following strategy makes money because of this 5%. In fact, most trend following strategies win rate is between 25 and 40%. So let's take this and look at it for a second. The trend following, this is the return profile. These are trades. So here are all trades. So trend following only makes money because of this fat tail, which is less than 5%. Once you implement a profit target on the strategy, this fat tail goes. Yes, because this is like, for example, Tesla. I don't know if you've seen a chart of Tesla. If you're trading Tesla as a trend following, and let's say you have a profit target, your profit target will exit here, here, here. It will never stick around till here. It doesn't work. Yes, that's the whole thing. It's a profit target. It's a target. It's either an ATR, a money, whatever it is. It will not capture this fat tail, which is the trend following trying to do here. So profit target will never work on long-term trend following. Profit target will work perfectly well on intraday trading. You want to capture that move, which you know it's going to end in probably an hour or two. So you want to put your profit target plus your whatever exit is. So let's say this strategy exit when the RSI is greater than 75. Plus I will add the profit target. So in case the profit target hits within the first hour, I'm out. I'm already happy. I'm out. I don't want to wait. I don't want to wait till end of day till I realize the RSI greater than 75. So profit target, stop loss, and trailing stop. It's not a one answer fits all. Either works or doesn't work. No, it works depend on what you're doing. And that's the whole point of these series of videos I'm doing is, yes, we have SQX to automate things, but you need to understand how the gears work in order to build. It will be a lot easier to build robust strategies when you have this information. For example, right now, let's say you build a template to build to automate the process of building intraday breakout. Yes, breakout strategies, intraday, exit, end of day. Well, now you understand that profit target works there. You should add it to that template. But let's say you're working on swing trading. Okay, say, I don't know, you're holding 3-4 days. I can tell you most likely profit target will not work. Because again, you don't want to limit your potential. So, when you understand this, then you build it in the template, and then SQX will be a lot easier for SQX to build robust, profitable strategies.
One more question. I'm trying to download some data from TradeStation right now. I'm not sure what's the specification of some instruments. Let's say I'm trying to download, let's say, the bigs, and I don't know the specification or where I can find this information.
If you right click or double click or edit symbol, go to properties, and so for example this is the ES, minimum move is 25, big point 50. So divide 100 by this number, that's the tick. So in SQX, when you create a symbol, let's say you want to add test and say, so say this is empty, not this one. So this is the tick, 100 divided by, so 100 divided by 25, and then the big point value again is here. And if you don't have TradeStation, you can find this on the CME. So let's say you're doing gold futures spec. So CME should always be the first result, and it will state, so it's $10 per tick, and then the big point value, let's see, the units. So 100 times, no, big point value, let me see. No worries, you can find it somewhere else. So bar chart always has this also. So here's the tick size, 0.1, and big point value, again, it's not here, contract, $10 per contract, 0.110, yeah. So you divide 100 again, so just like here we divided 100 by the minimum move. So here you divide 100 by 0.1. Oh, here you divide 1. I know it's $100, the big point value, but I don't know why I don't see it. There it is. Okay. Okay, so the tick, which is $10 minimum tick, and the big point value is 100. And you can actually probably bar chart is better. So let's try maybe silver. So silver futures is SI. This is Silvergate Capital. Let's try corn. Or we can test it here. So silver futures spec bar chart. So for example, silver is $5,000 big point value, and minimum tick is 0.005. Anyway, so TradeStation, right click, you have it here. Note TradeStation, bar chart, and you find it here. And of course, if so, for example, you only need to do it once. So say I just brought a new session, let's say the ES from 12 to 3. You build it here, let's say ES 12 to 3. So now you only need to pick on which instrument instead of adding a new one, because it's already there. So you just pick the instrument and then it will populate all these fields.
Yeah, I'm asking because I'm trying to use micro futures. That's what I'm asking.
Yeah, same thing. So MES. Just divide by 10, just as a general rule. Mini is 1/10 of the big contract, micro is 1/10 of the mini. But anyway, say you don't know. So same thing, 100 divided by 25, big point value is 5.
Yeah, it was just around when I'm doing walk forward matrix testing, you get the various runs through on the results, and so obviously the trades and the equity curves look very different from, say, I don't know, 5 runs at 20% or 15 runs at 30%, etc. How do you get those results into, say, quant analyzer so that I can then work out the correlations?
So you're doing walk forward matrix, and sorry, I missed that part. So you want to take the result from that to check correlations? Is that it? So if you're trying to export, let's say you found a stable region for 4 runs, okay? Then the only way to export those runs is to run them separately. So I don't know. Let's for example, let's say you 10 SMA 10, SMA 15, SMA 20, SMA 25. Let's say those are the stable region, and you want to get the results when the SMA is 10, when the SMA is 25, and so on. So you need to run them, each one separately, export their trades, and then bring them all in to do whatever. Like WFM will not give you the it will not give you the trades for each one. It's just, it will do the calculation. Yeah, but here it will be each run separately, and then you have to export. Like there is no, you want to combine them all together, correct? I don't have the example here, but let's say this one is one of the runs. The out of sample will be will be green. It will have a different set here. Like when you, so theoretically this is, let's say, run 1, and you go and you have your out of sample. So it will be separated, but you still have to go in and I'm trying to think here. Yeah, you still have to go in and delete the one that is not out of sample. Or actually, you can sort. I think you can sort on the out of sample, and then it's you still have to delete, but it will be a lot easier. So let's say this is the trades. You can sort on the out of sample here, and then it will put all the in samples in the beginning, all the out of sample at the end. And when you export that, you can easily delete the first half. So you'll only have the out of sample left.
So are you saying that on that screen I can generate a CSV file and bring it
Yeah, this one is easy. Like you just export CSV.
I'm not so sure that you can bring those CSV results into Quant Analyzer. Yeah. So that's my, because like what I'm trying to do is, say I've built one strategy and then I've built a number of different strategies all together. I then want to build a portfolio of, say, I don't know, 5 or 10 strategies, for example, and I want it. So how would I get to build a portfolio then that has a certain correlation based on those walk forward runs?
So your portfolio will be on different strategies. Well, first of all, the problem with Quant Analyzer is it can shuffle the trades of the portfolio, but that's it. That's the only thing it can do. It will not tell you, for example, well, how much money do you need to trade this portfolio, or let's say the correlations between. But in any case, I think there is something important here. When you run the walk forward matrix, I don't think if I'm understanding you correctly. Are you saying you want to use whatever the matrix gave you as a stable region? Like let's say it gave you a stable region of 9. Do you want to use those 9 strategies in a portfolio? That's not what you're doing, no?
No.
Yes, okay.
So what I'm doing is I've built a strategy. It's then a stable region according to my criteria. It then obviously produces an equity curve for that strategy, which is very different to some of the other runs, but the stable region is the one that I want to use. So I then want to be able to compare that equity curve against, say, the same stable region on other strategies, so that I can then build a portfolio that is obviously a certain correlation amongst each other.
Correlation there is a lot easier in SQX, because if you have all the strategies, you can easily add them in retester and put them in a portfolio and do the portfolio correlation. So that is simple to do. But to do so for example here, so say you brought the strategies together and now you go to correlation, and you can do it on profit and loss, you can do it on open trades, but I'm assuming you have the strategies already there.
Yeah, but it doesn't. Yeah, that's what I'm saying. I can't get the file to be able to check to see if it is correlated or not, because it's not the true equity curve. I've only got the stable walk forward.
Yes, I get
curve
it.
on the walk forward.
So what you're saying is the strategy is stable, is robust, But now when you tested it, it does not include the changes in the out of sample.
Precisely, yeah, because it constantly re-optimizes to generate the unique equity curve. The only other way I can imagine you could do it is if you generated the CSV file.
Yeah, and then you can
my
do
Excel
it in
skills. Maybe you can work out the correlation in Excel, but I'm not that good at Excel.
Yeah, it's not that big deal. I mean, it's a command. You put the data in. It's two columns, and you just say calculate correlation. That's it. Like there is nothing to it. It's the hassle is importing and exporting. That's the only inconvenience. But in Excel, the command is called correlation. And you just need to give it two sets of data. So theoretically, column A will be profit and loss of strategy A. Column B will be strategy and loss of strategy B. And then you do the correlation. But still, it's a hassle to export and import them into Excel. I'm just trying to see if you can do it here in SQX.
Yeah, the other thing with Excel, it's not going to compute, say, 5 out of 30 different strategies to find out which one is the most profitable when it comes to still having the right correlation. Whereas with Quant Analyze,
it will. Look, you can do all this in Excel. It's just, if it's one project, totally doable. There is nothing to it. In Excel, it will be like I mentioned. So let's say B, A, B, C, D. Let's say you have 4 strategies. P&L, 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 P&L. You run correlation. It will give you correlation matrix. And at the bottom, this can have the PL, total PL. This is all doable, one project. But let's say now you want to automate this. Now it's a hassle, correct? But if you're doing one project, totally doable in Excel. You can do actually everything in Excel. No need to, don't be afraid to use it. And in fact, anything you get stuck at it, a simple search on YouTube will yield all the solutions you want. But I can, because I've done correlation in Excel. I even have a video on the channel. I remember I did something in Excel on correlation. It's just, it's not, what you're looking theoretically is you want it here in the custom projects. You want to be part of the build, part of the workflow. And that's what I'm trying to think to do. But in Excel, definitely doable.